Well, hello everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I'm a coach and senior manager with Charles Schwab, and delighted that you guys are joining me today. It was introduction to this world of looking at charts, which we now know as technical analysis, that had me fall in love with this world of investing and trading. And when I saw charts, it just made sense to me, and I found it very empowering. So we are back at week 1 in this Getting Started with Technical Analysis series. If you are brand new to this, you are in exactly the right place. If you are a seasoned veteran and just looking to, do a bit of a refresher, you're in exactly the right place as well. We have the fantastic Mr. Ben Watson with us here today. If you have never attended a live event, you are missing out. We are doing 24 in-person events this year. In fact, Ben and I, along with a cast of others, are heading for Chicago on Friday. We have a market drive coming up on Saturday. And so if you have never been to one of these events and you're interested in checking it out, I encourage you to go to schwab.com/coaching. And then when you get there, come to in-person events. Because one of the questions when I say okay, we're going to be in Chicago, I'll hear people say, well, are you going to be, coming to the East Coast or the West Coast? Well, we're going from Chicago to Orlando. So for those that, want to see us head east or south and east, and then we're, the one after that is on the West Coast. We'll be in Anaheim for a market drive event, and then in Houston. And last event of the year is in Miami. Okay, the weekend before Christmas, no less. And last year, this is an advanced options workshop. This one, it's a 2-day workshop. The week before in Houston is an intro to technical analysis and options. So if you're new to technical analysis, you may want to check this out. But that's where you can find it. We now have the entire first quarter loaded, so that if you want to plan on attending one of these, you can see what's coming up through the end of March. Okay, so getting back to our regular programming, I invite you to follow us on X if you're not doing so already. My handle, Barb Armstrong CS. Ben Watson's is Ben Watson CS. Yeah, somebody said, how convenient, Miami in December. But, Ben and I live in Salt Lake City. It is a whole day just to fly there because we have to fly through Atlanta. But we love you enough to do that, my friends. Yeah. But you'll notice that we tend to be in those warmer locations, at the beginning of the year. I think someone has planned it that way. It wasn't me, but I'm happy to go. In any event, everything we cover in this class is for general information purposes only. None of it to be construed as a recommendation or investment advice. We're going to look at a lot of different charts today. We will be using the Paper Money software application on the thinkorswim desktop platform, to look at the charts we're looking at and do an example trade. And while our focus in this class is technical analysis, that doesn't mean that we're recommending that you make a decision solely based on technical analysis. You're going to want to consider what's going on in the news, look at fundamental analysis. In fact, my class yesterday, Trading a Smaller Account, I think I titled it, making trading decisions sometimes based on the news or using news to help you make decisions, but fundamental analysis plays a part as well. And just because something's happened in the past doesn't mean that it's guaranteed to happen in the future. Yeah, somebody's saying Alaska needs love too. Hey, if we could get something scheduled in Alaska, I would be the first one to sign up. I have never been. So would love that. So, I have designed this class to be taught in a 9-week rotation. I often will add a week 10 at the end. And last week's was, I think it was the 8 things I wish I had known about investing when I got started. So if you missed that, you may want to go back and watch it. If you subscribe to the channel, it's easy to find the playlist. So, if you haven't done so already, you may want to hit that button in the bottom right corner of your screen. But we're back to the beginning, intro to technical analysis. So that's what we're talking about today. And we're going to look at, like, what is technical analysis and why do we care? And then look at some of the principles and some of the charting basics. And then we're going to go out and look at a bunch of charts, because I think that that's where the real magic happens. We can talk about concepts all day long, and there is a course on technical analysis if you sign into your Schwab account that you can go through. And I encourage you to do that as well. But it's when we see it live on the charts that it's, my eyes lit up. So, there are, when we look at the goals of technical analysis, there are two analytical approaches. One is to look at what has happened in the past with respect to price and volume, and to look at that as a way of projecting trend. An object in motion tends to stay in motion. And so if something is uptrending, one might surmise that uptrend might continue. And if something is downtrending or rolling down the hill, one might expect the downtrend to continue. And we're going to look at stocks that, are moving both up and down. And then we look at fundamental analysis, so technical analysis is looking at the charts, where fundamental analysis is kind of looking under the hood, if you will, and looking at the company's financial statements, their balance sheets, their income statements, looking at, are they growing their sales year after year? Are they growing their profits? What does their price earnings ratio look like? And if you aren't familiar with some of those things, you might want to do a little digging into the basics on fundamental analysis. Now, when it comes to technical analysis, they say that price moves in trends, and it does. And, it's important for us to be able to see those trends, right? Oh, sorry, I didn't mean to do that. Let me come back. I wanted to bring up my drawing tool. And so when we say bullish, bearish, and sideways, bullish, we really mean uptrending. So we're looking for stocks that are moving from left to right, that are, and this is over time. So this would be today. And this might be, 3 weeks ago, or it could be 6 months ago, but we're looking for an uptrend. So that's bullish. Bearish is a stock that is downtrending. And if you want to see a downtrending example, we could look at something like a Lulu. Here you might want to look at a stock like a GE. Or General Dynamics has been uptrending, and we'll look at some of these on the charts. And then we sometimes end up with stocks that are going sideways. They kind of come up and hit a peak and roll over, and they're, when you draw the lines, it kind of leads the eye and say, this is considered to be resistance or the ceiling, and this is support or the floor. And the market, in coming up with a price, they say the market discounts everything. And what do we mean by that? Is that the current price is a reflection or a representation of everything the market currently knows about that stock. And, often, although we say, past results don't indicate what's going to happen in the future, but they say that history often repeats itself. Or if it doesn't repeat itself, it rhymes, so because human beings, are human beings, and we tend to react similarly in similar situations. Okay, when we look at the benefits and the risks, so what's the benefit of looking at a chart? Well, it helps us find those things like trend, support, and resistance. And some people find that relatively intuitive. Others need to practice a little, but it's flexible, and it can be applied in any market condition and in any time frame. So, and so this works, whether the market is going up, down, or sideways. We can use technical analysis as a guide. Now, what is the risk? Well, my kids would tell you that I am, a ridiculous optimist. Like, I'm a very optimistic person. So I might have a cognitive bias towards seeing an uptrend when maybe it's not really there. And if I'm using a cognitive bias and I'm not aware of it, it can lead to poor decisions. and poor decisions tend to cost us money. And what's another risk is that, slippage. So you bought a stock, say a stock is uptrending, and we've done several examples of this where the stock and it's starting to uptrend. So we buy some shares right here and we put a stop down here. But what if some news comes out and then you wake up the next morning and the stock has dropped like a rock to here? So we could end up out for a bigger loss than what we've accounted for. And sometimes that can happen. Okay. The other thing is that, how they say hindsight's 2020. Well, that applies to technical analysis too. We can look back at what has happened and learn from it, but we could, you can go, oh, in hindsight, I could see this was the turnaround, but how can we use our hindsight to provide us with some foresight? And that's what we're going to talk about in this class. So there is, but technical analysis, even though it is technical, it's a bit of an art. Like architecture is a combination of science and art, right? So is technical analysis. And so, I might see something different than what you see on the charts, and that's okay. But, when I first started, I would, be watching a coach draw lines and go, oh, like and have what I call a BGO moment. It was sometimes I would look at it and think like, wow, it's obvious now that you pointed it out, but I didn't even notice that. And the more charts you look at, the better, the more skill you develop, right? Right. Now, there are some discretionary and non-discretionary ways that we can look at things. So if we're looking at discretionary, and this is where some things come into place. When I talked last week about the 8 things I wish I'd known, one is that things like fear, and FOMO, which is a derivative of fear, and hope. These are 4-letter words in the world of trading. And so we can end up with some human interpretation and bias when we're looking at a chart and thinking, like, oh, this has fallen a bit, but I think it's reaching a support level, and the support level may or may not be there. And when you have a discretionary plan, it's hard to teach that, and it's difficult for others to replicate. And so if you have your whiz-bang way of looking at a chart that nobody else understands, it can, it might help you, but it won't help anyone else. But if you look at computer-generated signals, like I did a class a couple of months ago where we were looking at green arrows on a 30-day moving average as a potential entry point, and red arrows as a sign that we needed to snug up our stops. When we see that doesn't require human interpretation. We're saying, hey, when we see this non-discretionary signal, this is how we're going to act. And when we're methodical, we're not replying, we're not looking at fear or hope. These are not strategies we're employing. So we're not using these as strategies. What we're using is a plan that's very methodical, a trading plan. And I've created a whole bunch of them and put them in the trade management mini session series. And so now, what's the thing with a non-discretionary? It may not adjust for nuances or for, kind of bluebird events that you weren't expecting. Okay, but this is something that other traders should be able to replicate, and you should be able to replicate with other trades. So if you have a plan and you say, well, if I'm looking at a trend trading growth stock, this is when I get in. This is how I position size. This is how I manage it with my daily or weekly routines. And this is when I snug up my stop. And you might say, well, that's kind of nuts, because if I am buying a stock, like let's say I bought a stock here and it's continuing to go up, why would I get out? Well, you wouldn't. Like, let's say you bought it here. Good for you. Well, maybe when it comes back here and starts up again, you know, and we had our first stop here, maybe you move your stop up. That's part of your discipline, and move it up again. And as long as it keeps going up, you know, you just keep moving the stop up and you stay in the trade. You know, but if it closes below the 30-day moving average, and let's just say this has been kind of bouncing off the 30-day moving average, you say, if I get a red arrow here, then I'm going to snug up my stop. And it's part of this plan. You're not just like flying by the seat of your pants, not a plan. And so technical analysis and having a plan that is based on what's happening on the charts, or where charts are part of it, or your interpretation of what's going on in a chart, you know, can be part of it. And you know, so here's this investing plan idea. You know, almost think I was planning on talking about that, right? Like, so here's our plans, and it's, you know, do we have a watch list? And, you know, a solid trading plan will have a what to buy, when to buy, how much to buy, when to get out, and daily, weekly, or monthly routines. So if you want to see where the examples are that I've created, I'm going to bring up, and this is where I said, you know, you're going to want to subscribe to the Trader Talks channel from Schwab Coaching. And when you first get here, you'll see the fabulous Mr. Ben Watson. What will come up first is whatever is currently playing. And then if you click on playlists and scroll down, we're looking for trade management mini sessions. So as part of the technical analysis series, and they're in the technical analysis series also, when we look at candlesticks, I've done a short series. They're all like 5 minutes or less on different candle patterns. But what you're looking for is these in blue. So here's a simple stock investing plan. And we first covered that in the Getting Started series. So you can go back to the playlist for the Getting Started with Technical Analysis series and you know, find the class where we went over this. Okay, so that's where you access that resource. And this is why, you know, because we want to create a repeatable formula. Like I say, like if you own a Starbucks franchise, my expectation is that they go through the same routine to open the store every day. And when you go in and order a venti cappuccino, they make it the same way every time. They don't think, oh, today I think I'll do it a little differently. No, you know, McDonald's, Big Mac, 2 all-beef patty special, sauce, lettuce, cheese, pickles, onions on a sesame seed bun. Hasn't changed since the 70s. So now chart basics. So chart is a function of time, which is our bottom axis, and price. Okay, and this is a line chart. Now, most of us do not use line charts. You know, there are some that do, and what line charts tend to do is kind of take away, you know, some of the distraction, and it just plots the closing price each day, and then it just connects the dots. And they may be colored, you know, red when they're coming down and green when they're going up. And then volume, you know, can give you an idea of when a lot of buyers and sellers are very active. And so, you know, and this is usually at the bottom of your chart. Okay. Now, when we look at individual bars, a bullish bar is where the price closed higher than where it opened. So here's opening price, closing price, the high of the day and the low of the day. Now, in this case, it opened here, closed here. so it's bullish. In the second example, which is bearish, it opened here but closed lower. So the price closed lower than where it opened. And so that's considered to be a bearish candle. So some of the, basics, the open is on the left side and the close is always on the right. So if we see here, that we have a green candle, it opened here, closed here, that makes sense, right? So the close is on the right, and then the range is this vertical bar. And if it's green, it means it closed higher than the close of the bar prior. So you can see here, it opened here, closed here. So it actually rose from where it opened. But if you're using trend, it still closed lower than yesterday's close. And that's why the red bar means it closed lower than the close of the previous day. And this just depends on how you set your charts up. And I'll show you that in a minute. Okay, now when we look at a price bar versus a candlestick, and I think every coach on our team tends to use candlesticks. So here we had it open here and close lower, open here, close higher. So this is a red candle because it closed lower. This is a green candle because it closed higher. Okay. So, John, we currently do not have a class dedicated to fundamentals, but Scott Thompson is teaching a basic stock investing class, and my guess is he'll cover fundamentals in some of those. But at this time, we don't have a class dedicated to basic fundamentals. So when we look at our bullish candle, and we just kind of went over this, open, close, bearish, open, closes lower. Okay. And so, our candle charts show the open and then they show the close. So here was our open, here was our close, and then the wicks show the high and the low of the day. Okay. And if, a red candle, if you're using a simple candle presentation, a red candle means it closed lower than where it opened. A green candle means it closed higher than where it opened. Now here, you'll see this candle, it closed lower than the candle of the previous day, but it opened lower and closed higher. That's why this one is green. Now, we're going to come out to the charts for a second because I don't want to confuse you, but if you're looking at my chart, and if we look at INTC, we can see here that on this day, this stock closed down a little bit. The next day it gapped up. But this candle is dark green. Why is that? Well, it's dark green because it opened high and closed a little lower, but it still closed appreciably higher than the close of the day before. The close of the day before was 24.90. The close on this day was 30.57. But it depends on how your chart is set up. So if I come to my sprocket and come to appearance, I have it set up as candle trend. If I have it set up as simply candle and apply it, this candle would be red because it opened higher and closed lower. When you set your chart to candle trend, then it puts it in context of the previous day. And so that's how I prefer my charts to look. Like this gapped up and had an extraordinary day. So it kind of bugs me if that candle's green. But I mean, you can do it however you like, but you're coming to appearance and candle trend. And one other thing I want to point out, if you're doing this as candle trend, then on a day like this where it opened higher, closed lower, but obviously higher than the day before, that will be dark green, like this candle here. It's a green lining around the candle if it opens lower, closes higher, and closes above the previous day. So that's how those work. Okay. And if we come in here, the same with the red candles. So here's a candle that has a red ring around it because it closed lower than the previous day, but it opened lower, it closed higher than where it opened. Where this day, it closed lower than where it opened and closed below the day before. Now we're going to spend a whole class just on candles. So I don't want to get into the weeds here, but I wanted to just add a little context. Okay. So, and every chart is going to, whether you do your, you have your days expressed like this or in candles, there's an open, a high, a low, a close, and then the range for the day. And so if I come back out, and let's just come to a 6-month chart. So if I look at today, and if you look up here, it will give you the stats for today's candle. You know, it opened at 33.93, high 34.24, low 33.02. And if it were to close at this moment, it's currently trading at 33.31. Now, if we come back to this day, you know, and then the range on this day was $2.22. And it opened at 31.78, high was 32.38, low was 30.16. So as you hover over any candle, that information at the top left of your screen will be shown. Okay. So, and we can look at candles in different time frames. And so, like, I have my time frame set up. I can look at a 3-month, a 6-month, a year to date, a 1 year, a 5-year goes to weekly. If I do a 10-year chart, it goes to monthly. So we can look at, you know, this is a 3-year chart. So we can look at a 3-year chart. We can look at a 6-month chart, or we can look at something measured in hours. And sometimes people will do this or measured in minutes if they're looking after hours at an earnings announcement. And it's crazy to see, how fast a chart can move. We tend not to look at these in our classes as much day to day. We're looking more at the charts on this side, either weekly or monthly. And to change these on our charts, we're just simply going to come up here to our time frame. And we can see here, if we wanted to look at Intel, a 10-year monthly, each one of these candles now represents a month as opposed to a day. All right. Now, volume, when we look at volume, it can help illustrate the strength of a move. And it doesn't indicate direction as much as it does indicate strength or interest. Like, and if you have a flat day with high volume, it can be an indication of indecisiveness. But what it tells us, if we have high volume on a flat day, is that there's a lot of people in there duking it out. Lots of buyers and sellers, but no one's really taken charge. No one's kind of won that battle of tug of war. The rope is still in the middle. And an up day with high volume is generally considered to be more bullish than if that up day had low volume. And a down day with high volume is a stronger bearish indication. So like if we come back to Intel and we come back to a 6-month chart, this day where the stock gapped up, look at the volume. So there were a lot of people all of a sudden coming in and driving this price up. So that's considered more bullish. And even though it did pull back for a couple of days, it seemed to rally pretty quickly after that. Okay. Okie dokie. So we've already looked at some examples on a chart, but I've got some others that I'd like to kind of draw your attention to. So there's this little company called NVIDIA. I know some of you may have heard of it, and I'm kind of jesting because, like, if you come and look at the Market Watch tab and we look at the S&P 500, NVIDIA is one of the biggest companies on this index. If we look at the NASDAQ, it's a $4.5 trillion company. So it is a pretty heavy hitter on every index that it participates in, right? But if we look at NVIDIA, we had a stock moving. How would you characterize this trend? From April 7th, which seemed to be the day the market turned around, up through here. It pretty uptrending, right? And in fact, like if we look at this move, if I change my drawing tool, it moved up 100 and almost 110%, from April to the end of July. And year to date, this stock is up 35%, but then it started to go sideways. And if we look at this, it's like, well, how did we characterize this as a sideways trend? Well, it kind of came down, didn't it? Came up. Oops, I didn't erase my Etch-a-Sketch. Just let me change my drawing tool. It came up, hit its head, and then it came up, and it's like again and again and again and again and again and again. It just kept, all of a sudden, like this 184 level seemed to be a ceiling, and it kept like banging on the ceiling, but couldn't get through. And then it pulled back, came down to around this 167-ish, came back up, hit its head on the ceiling again, came back down to this. And I put an ish on it because it's not a specific number, it's a range, and then it came back up, didn't quite make it up here, came back down, hit its head, and then it bounced off the floor. It's almost like it's on this tramp, and then it came up almost right, hit its head right there. And today hit its head yesterday. And some might have seen this as, ooh, is this indicating that this uptrend may be hitting its head on resistance and it's rolling over? But today it's breaking out. Yeah. So some might see this as an entry. Others might say, like, hold on to your horses, my friend. What I'd like to see is I'd like to wait for it to kind of, maybe if it moves up for a couple of days and then comes down and bounces, now I have a retest, and then I'd look at getting in. And, others, okay, what could happen tomorrow? It could just come right back in. So this might not be a breakout. It could be a fake out, and we won't know. And some might say, I'm in. Well, it's, and you could say I'm in because I'm seeing it break out above that, 184-ish level where where we saw resistance. And others would say, well, that's a more aggressive entry. Yeah. And if you want to add something to your charts, you would come to studies and edit studies. And then you could type in volume. Average volume, and add volume. Okay. So it's already on the chart, or if you reset your chart to the default, volume will be there. All right. Okay. So that's NVIDIA. The other thing I wanted to point out with NVIDIA is that when we had this pullback back here, look at where the volume went. 600 and this isn't 611 million shares traded that day. On this day, 612 million. So, when, it had this move to the downside, we saw a lot of volume on the chart. Okay. And like we did on Intel when it gapped to the upside. So let's come and look at CoreWeave. Now, one of the things that you one of the things that you may notice when you look at this is that, hey, how come the line doesn't go the whole way back? And I have a 6-month chart. What if I changed it and made it a year-to-date chart? Well, my chart didn't change, and it should show January through March. Well, what this is telling me is that this stock IPO'd, it became publicly traded here on this date, on March 31st. And this is why the moving average doesn't go all the way back to that date. So this 30-day moving average didn't start until, which is what this red line is, until 30 days after it launched. And this little black line is a 100-day moving average. So it needed 100 days worth of data before it would even appear on the charts. So when you have a chart, like this, I just thought I would point that out. But, we've had some days with this stock where the volume was very high, and that's just it can be considered a confirmation of momentum, one way or the other. Okay, and some would look at this and say, well, I've drawn this line and I see a diagonal resistance breakout, and then it pulled back, came back to, old resistance, old ceiling became a new floor, and now it's moving again to the upside. Okay. Okay, so that's that one. Let's look at a couple of stocks that are downtrending. So how about Lulu? So when we look at Lulu, it's been kind of rolling down the hill, hasn't it? Like all year long. Like this stock is down 53% year to date. And if you don't have this red bar on your chart and you'd like to add it, I do have it in the scripts pinned to the top of my X feed, so you can go out and find that there. But you can also come here and change this to manual and show price as a percentage. And now when we look at this, we have a year-to-date chart, we can see that the stock is down, 52.2% is where the red line is. So it gives us, so one thing with scripts is they're not guaranteed to be absolutely accurate, but it gives us a good estimation. And this is trading below the 100 and below the 30. And, it looks like it's come up and hit its head, bonked its head here for a bit, and then continued to fall, came up, looks like it's bonking its head again, and maybe continuing to fall. How about Lilly? And so, is this a breakout? Because, when we draw this line here, it seems to have come, and some might say, well, I'm going to duplicate that line. It seems to be in a bit of a downward trending range, doesn't it? And then it's come down here. And it's up here bonking its head. So today it looks like it's peaking above. And again, the question might be, is this a breakout or a fake out? And how would we tell? Well, if tomorrow it's back below the line, I'd put it in the fake out category. And if it continues on above and then comes back and retests and bounces, well, maybe this downtrend is now changing. So the trend is your friend until it ends, right? How about if we look at some sideways trending stocks like a PFE, Pfizer? Now, Pfizer's not exactly crushing it this year. It's down about 4% year to date. Even with today, it's up 6% today, but still, according to this range, down 4.7% on the year. But it's been in kind of a range, right? Like it came up to about this 23 level, went all the way up to almost 26, came back down to where? 23, came back up. Didn't come down quite as far this time, but the question will be, will it break back above this 26-ish level? And it's been in this range since when? Since the beginning of June. So stay tuned. And none of these are recommendations, they're just observations. Now, if we want to look at something uptrending, how about Western Digital? So this has just been marching up the hill, for months. In fact, it's barely come back and kissed the 30-day moving average. It appears to have been using this 10-day moving average as a support level. What about General Dynamics? And again, using this 30-day moving average as a support level, up 28% year to date and continuing on up, and today breaking above this previous high. So that's General Dynamics. How about STX? Oops. And this will have to be our last one because, we are running out of time. Yeah, so when we look at Seagate, another one, like just walking up that hill, kind of went sideways for a bit of a hot minute, right? And this is where I find, if I can get my drawing tools to work, it just kind of caught its breath, but it really, it really didn't pause for long, and then, moving to the upside. And so might some considered yesterday to have been an entry for this stock? Yes, if you wanted to add it to your portfolio. And where might one put a stop? Well, you might say, you know what? Sorry, let me just change this back to show regular price again. You might say, well, the low on this day was 213, so I might just put a little bit below that. And as long as it stays above that, we're good to go. Okay. And had you bought this back here, when it crossed the 30-day moving average and bounced, your first stop, just let me get my drawing tool. First stop might have been down here, below here. And then when it came back up and moved back, or you might have said, like, as long as it stays above the 30-day, I'm not changing it. And so you may not have, until you had a red arrow here or it kissed here, then you might have moved your stop up. And now what you're trying to do is not just define your risk, you're trying to protect some of your profit. And then it continued on up. Maybe when it's kissing here, you move your stop up to below here. Maybe even though it's not come back to the 30-day, you might just say, hey, I'm going to use this as a support level, so now I'm going to move the stop to here. It depends on what your trading plan suggests, right? Okay, so that's a wrap for this class. I appreciate you being here. I appreciate Ben's help in the chat. I appreciate the guys behind the scenes. So I want to thank all of you for helping bring this class to life, to each and every one of you for showing up. And don't forget, please follow Ben and I in the Land of X, Ben Watson CS and Barb Armstrong CS. Please hit the like button. It helps move this up in the trading, in YouTube land, so that more people can find this content. I like to say you could be doing a favor for a random stranger whom you may never meet just by hitting that like button. And then don't forget to subscribe to this channel. So guys, I hope you have found this helpful. Thank you so much for joining me. Lots of great content still to come today. I hope you'll stick around, and I'll see you tomorrow for Trading Price Patterns. Take care, everyone. Bye for now.